We'll take another look at the job cost flow for a job order system. This time we'll look at the journal entries. But keep in mind, what we're talking about is the cost that flows here parallels the physical flow. We just went through the physical flow before. Now we have different accounts. This is the, let's call raw material account. That's the inventory. Then you have work in process. And then you have finished goods account. Then finally you have the cost of goods sold, which is an expense that we recognize the item once we sell it. But keep in mind that all the costs that go into the production of my finished goods are product costs. They're the costs of inventory. Now, to begin with, if you want to visualize it, manufacturing costs three parts. 1, material. 2, direct labor. 3, man overhead. Now, these are all assigned to the work in process, and we keep working on the truck until we complete it. When we complete it, we transfer it to finished goods. We credit work in process, debit finished goods, increase finished goods. Then when we sell it, we credit finished goods and we debit the cost of goods sold. So that's how the costs flow through the accounting system. So to begin with, let's say we purchase raw material. We have a raw material account and we purchase so much direct material, so much indirect, but all of it together. So we debit raw material, $42,000, and we credit payable or cash, whatever the case may be. So we have the account raw material, the material going into the account. Now, the labor costs. The labor costs are in three parts, of course. There are also what we pay the guy, but plus the benefits and employer payroll tax. All of that forms the cost of direct labor. So let's assume that Wallace incurs $32,000 of factory labor costs. Of that 32, 27 relates to direct labor. 5,000 relates to indirect labor. So the journal entry is debit the labor, 32,000, credit the factory wages payable, 27,000, and taxes payable, 5,000. So the manufacturing overhead, recall, is the difficult one. Then all the manufacturing costs, property taxes, depreciation, indirect labor, indirect material, insurance, repairs, all of those things that were reasonable and necessary to produce my product are part of manufacturing overhead. They are costs that will form part of the cost of my product. There are other costs which will be expensed. These are period costs. But what we're talking about here is the manufacturing overhead account and debit manufacturing overhead. And what we do is every time we apply overhead to the account, we put it in here. When we incur it, we put it there. So here we have all these overheads, okay? They were credited out of the payables and prepaid insurance and so on. So we debit manufacturing overhead, $13,800. So at the end, you see, here is all the actual manufacturing overhead incurred. Here is the applied. So let's assume I incurred about $100,000, but I only applied $98,000. Well, you can see that I underapplied by $2,000 because I have a debit balance of $2,000. If I applied $104,000, then I would end up with a credit balance of $4,000, and that would be overapplied. I overapplied the overhead to all the jobs worked. Now remember, I applied them based on either direct labor hours, direct labor cost, or machine hours. But I used a predetermined overhead rate, and I multiplied that by the actual amount of machine hours to assign it to the job. So if one job took more machine hours than another job, it would pick up more of the manufacturing overhead. And therefore at the end, I compare what was actual with what was applied, and I make an adjusting entry. By change, I debit the cost of goods sold. That means I bring it up because I underapplied. I didn't apply enough. I have to have my cost of goods sold as actual. Right now, the cost of goods sold has the actual direct material, the actual direct labor, but an estimate for the overhead. And if that estimate is low, then I debit the cost of goods sold to bring it up. If the estimate is high, I credit the cost of goods sold to bring it down. And therefore, let's assume here we had a credit balance, which means that the cost of goods sold was too high. I applied too much to the goods produced. At the end of the year, I have to adjust for all production for the year, and I do that by debiting manufacturing overhead and crediting or bringing down the cost of goods sold. And that is the way I take care of the manufacturing overhead. So hopefully you can see from the journal entries and the cash flow, you can put it all together.